Anaam Holding, a Jet livestock trader that became a holding company, listed as 4061, and a balance sheet with a clock on it. In 2025, revenue was 40 million rials. The operations lost 7 million, but interest of 11 million turned that into a 20 million net loss. Real assets, a real season, and a debt stack that must shrink. The plan is a deleveraging, stated plainly. This is the complete CFO in business report. 3 signals stand out. First, the core still trades 40 million rials of revenue at a 56% gross margin. Second, interest eats the year. A 7 million operating loss became a 20 million net loss because the debt costs 11. So, the regime line is crossed. Accumulated losses passed 20% of capital, with a current ratio of 0.18. The plan runs 6 actions on one road: sell assets and cut the debt, own the Hajj season with contracts locked by Ramadan, work the receivables hard, lease the idle cold stores, shipment level profit on every lane, and exit the accumulated loss regime, sequenced from 2026 to 2030. Each action has a gate before the next. The SWOT is honest, because it must be. The strengths: a sheep import franchise, cold stores, and commercial property. The weak points: an interest build-up of the operating result and receivables at 271 days. The opportunities: the Hajj season, leasing, and asset sales. The threats: refinancing, disease, and another drifting year. Michael Porter's 5 forces drawn on livestock trading. Supplier power is real. Source markets, freight, and feed set the landed cost. Buyers have alternatives, so service wins. New entrants face import licenses and quarantine. Substitutes are frozen and local meat. Rivalry centers on the import lanes in the cold chain. Those are the defensible assets. The model runs from source markets to the sacrificial season. Import live sheep, quarantine, feed and hold. Keep the cold chain earning and sell through wholesale, butchers, and the Hajj window. Livestock is the core. The season is the engine. Property and leasing are the ballast. Each part must now pay its own way. 4 pillars carry the plan. The people pillar: buyers in the source markets and veterinary staff in the yards. The technology pillar: herd tracking, mortality control, and cold chain telemetry. The infrastructure pillar: holding yards and cold stores used or leased. And the digital core: shipment level profit and receivables worked every week. Every risk carries a probability, an impact, and a named owner. Refinancing leads the register, owned by Treasury with board watch. Receivables at 271 days are owned by collections. Disease and import bans sit with the veterinary and quarantine team. That is deliberate. Governance keeps the plan honest. The board sets risk appetite and watches the register. The audit and risk committee owns controls and capex stage gates. Management delivers a monthly KPI pack, a quarterly board review, and an annual plan refresh. The context is a kingdom that eats meat every day and sacrifices once a year. Food security policy treats protein import lanes as infrastructure. Hajj numbers rebuild the sacrificial market annually, but source market politics move landed costs, and frozen substitution caps prices. And the debt clock runs regardless. Every drifting quarter costs nearly 3 million in interest. The portfolio, drawn plainly: live sheep import, the founding trade; fresh and frozen meat; livestock shipping lanes; feed and fodder for the yards; cold stores; commercial centers; the Hajj and Eid season; the annual engine; and the holdings book from the 2022 pivot. Lanes, yards, and stores all must earn. Peer comparison at live market caps. Now the co-ord contrast. Jazadco carries a similar market value, sells almost 3 times more, and scraped a profit. And Anaam's operations nearly break even. Then the interest bill turns the year into a 20 million loss. The deleveraging case in one panel. Valuation, with every assumption on screen. Risk-free, 4.45. Saudi equity premium, 5.01. Adjusted beta, 0.9. The WACC lands at 8.4%. The plan discounts to 0.7 rials per share. The market says 11.94. Read the grid, not one number. No buy, sell, or hold verdict, ever. 5 catalysts to watch: asset sales, funding debt cuts through 2026, EBITDA positive in 2027, the hedge engine at full scale in 2028, bottom line break-even in 2029 as interest falls to meet the operations, and by 2030, a focused trading house again. 1 grid, 10 years. Actuals in green, plan in blue. Revenue climbs from 8 million to a planned 77 million reals. Earnings per share builds towards 0.1. No dividend is modeled. Every real serves the deleveraging, labeled illustrative, on every panel. 5 years in one picture. Revenue climbed from 8 million to 51, then drifted back to 40. One profitable year in 5, and that one carried by non-operating income. The share trades at 1.5 times book. The market pays for the assets. The plan must make the profit, and loss deserve it. 2 pictures explain the year. The bridge shows 23 million reals of gross profit, absorbed by 30 million of overheads. Then interest and other charges take 13 more. The cash picture is quieter. Operating cash was nearly flat. The burn has slowed, and receivables at 271 days are the coiled spring. The transformation map is a road back to focus. 2026, assets sold and debt cut. 2027, EBITDA positive. 2028, the hedge engine at scale. 2029, break even. 2030, a focused trading house. From holding drift, back to the trade jet at new. 9 numbers hold the budget up. Growth of 10 to 18% a year. Gross margin walking from 54 to 41%. Capital spending at 3.5% of revenue, easing to 4. Zakat and tax near 3%, and a payout near 0%. The balanced scorecard makes it accountable. Net debt below 90 million by 2028, owned by Treasury. EBITDA positive by 2027, owned by the trading heads. Shipment mortality below 1.5%, owned by the veterinary team. Every target has a cadence and a name. The 5-year plan, in numbers, revenue builds from 46 million to 77 million reals. EBITDA recovers to 16%. Earnings per share reaches 0.1. No dividend is modeled. Deleveraging first. All of it labeled illustrative, not guidance. The master budget allocates 2027 month by month. The sacrificial season rules. This budget May carries 11.4% of the year as Hajj and Eid al-Adha arrive. April builds the stock. Ramadan lifts the meat tables in February and March. The season is won before it starts. 12 months waited the way the season demands. 3 final charts close the budget. The Hajj quarter carries the phasing. Of every 100 halalas of budget, cost of goods takes 50, and EBITDA keeps 4. Firm cash compounds to 15 million reals across the plan. The complete Anaam holding report is live at cfoinb.com. That is, cfoinb.